Welcome to your quick guide on how to get a mortgage. My name is Michael Wallace. I'm a real estate and mortgage banking consultant, and I'm excited you've decided to join this session. For most people, getting a mortgage is the key to financing their dream of home ownership. In my quick guide series on how to buy a home, I briefly discussed the mortgage process, and today we're going to dig deeper into the details. By the end of this session, you'll walk away with the best way to manage the entire mortgage process and avoid mistakes that might prevent you from getting a mortgage or cost you time and money. In my quick guide series on how to buy a home, I discussed how important it is to be pre-qualified by a reputable mortgage lender before you start looking for a home. With a pre-qualification, you'll be viewed as a serious buyer and be in a stronger negotiating position. What type of mortgage is best for you? As the former CEO of a mortgage banking company in New York, I can tell you there are many different types of mortgage products, each with their own benefits and costs. Let me briefly address our mortgage system here in the U.S. and how it affects what mortgage programs that are available to you. The U.S. mortgage market is dominated by the GSEs, or government-sponsored enterprises. They set the credit underwriting standards to determine who can qualify for a mortgage and for how much. Fannie Mae and Freddie Mac are the GSEs that set the standard for conventional mortgage loans, which are the most popular type of mortgages originated in this country. FHA and VA mortgages are mortgages insured by the federal government agencies and are designed to offer more flexible underwriting guidelines with lower down payment requirements, which offer greater opportunities for home ownership. There are other private mortgage conduits, but for the purpose of this video, I will focus on mortgages backed by the GSEs as they set the standard. All of these loans are sold into the secondary mortgage market, which will be the topic of another video. All I will say about the secondary mortgage market for now is that if it did not exist, there would be no fixed rate mortgages in the United States. Fixed rate mortgage loans have a fixed rate for the term of the loan and are amortized over the life of the loan. For example, if you have a $300,000 30-year fixed rate loan at 6%, your principal and interest payment will be $1,799 a month. That does not include your monthly escrow payments to pay your real estate taxes, homeowners insurance, and mortgage insurance. This money is held in an escrow account and paid when due on your behalf. Your total monthly mortgage payment will include principal, interest, taxes, and insurance. If you put less than 20% down on a conventional loan, you'll be required to pay PMI, or private mortgage insurance. FHA mortgages also require mortgage insurance. Other type of mortgages include adjustable rate mortgages, or ARMs, which offer lower interest rates to start than fixed rate loans. They will adjust according to the terms of the mortgage program. I will address adjustable rate mortgages in greater detail in a separate video. Based on your individual circumstances, your mortgage loan officer will explain the potential mortgage products that best suits your needs and the associated closing costs. To make that determination, he or she will need to review the following: your credit history. Your loan officer will run your credit report and review it with you, including your credit score. For a conventional loan, the minimum credit score is 620. FHA and VA loans have a minimum credit score of between 580 and 620. Your credit score is determined by many factors, including your payment history, amount of your outstanding credit, and the length of your credit history. If you see something derogatory on your credit report that is not correct and you can document it, you may be able to dispute it and have your credit score adjusted accordingly. This process can take some time, so it should be started as soon as possible if you need to improve your credit score to qualify. Your loan officer should be able to help you with this process. Your credit score is very important as it will affect your interest rate and the terms of your mortgage. Verification of income. They're going to look at your job stability. Lenders like to see that you have at least 2 years on your current job. However, if you have a new job in the same line of work and you have a good reason for it, switching jobs should be just fine. To verify your income, for salaried and commission-based employees, they're going to ask for W-2s for the last 2 years and your last month's pay stubs. For self-employed borrowers, they're going to ask for your last 2 years' tax returns and a year-to-date income statement prepared by your accountant. For self-employed borrowers, they will average your last 2 years' income and your year-to-date income to determine your qualifying income. Qualifying ratios, also known as debt-to-income ratios, are what the lender will use to determine how much of a mortgage you can qualify for. For example, if a mortgage program has a 33-38 qualifying ratios, that would mean that your total monthly mortgage payment, including principal, interest, taxes, and insurance, cannot exceed 33% of your gross monthly income. And your total debt obligations, including the new mortgage, cannot exceed 38% of your monthly income. There are mortgage programs that allow your total debt obligations to go up to 45 or even 50% of your gross monthly income, depending on the compensating factors of your case. Even if you qualify with these ratios, I believe that you should do your own personal monthly budget to decide what you can comfortably afford to pay. Verification of assets. The lender needs to verify that you have enough money for your down payment, closing costs, and money in reserves if your program requires it. To do this, they will ask for your last 2 months' bank statements and will look for any large deposits. The reason is they want to make sure that you did not borrow the money from another source, which would require another payment, which could affect your ability to pay your mortgage. If you receive a gift from a family member and it is not required to be repaid, that's fine. The gift needs to be documented and the donor must sign the gift affidavit stating that it does not have to be repaid. This is common for many first-time homebuyers. After all this is reviewed by the loan officer and processor, it needs to be approved by the lender's underwriter. It is the underwriter's job to make sure that the borrower's application and documentation meets the underwriting guidelines for the mortgage program. Once you are pre-approved by the lender's underwriter, you'll be issued your pre-approval and you are good to go. Happy home shopping. The next step in the mortgage process comes after you have found your home and signed your contract of sale. Since you've already been pre-qualified, the formal mortgage application process should be easier, especially if not much has changed. It will require an updating of your credit review, income and asset documentation. The lender will order an appraisal of the property, which is performed by a licensed appraiser. The appraiser goes to the property and does a detailed report of the house, property, and area. They also find 3 comparable sales, also known as comps, in the area that are most like the subject property that have been closed within the last 6 months. If the appraiser can't find comps that fit these parameters, they may expand their search to include more comps or sales over a longer period of time. They must document their reasoning through adjustments in the value against the sales price of the subject property to come up with their appraised value of the property. The mortgage processor reviews the documentation plus the required disclosures and prepares the file to be submitted to the underwriter for approval. The underwriter has the discretion to ask for additional documentation if they believe that it's needed to ensure that the loan meets the investor guidelines. This can be asked for prior to the loan being approved or as a condition on the mortgage commitment at the underwriter's discretion. This is where I've experienced some interesting conversations between the loan officer and the underwriter, who at times have shared a difference of opinion. The loan officer wants to get their loan approved with the least number of conditions as soon as possible. And the underwriter's job is to make sure that they're covered by making sure it will meet all of the program guidelines. I have originated and underwritten many mortgages myself, so I understand both sides. As a CEO, I sometimes had to referee those differences and hopefully keep everybody happy. After your loan is approved, you will work with your lender, clear any underwriting conditions on your mortgage commitment until your file is cleared and closed. After any legal or title issues are cleared and your loan can be set to close, congratulations, you're ready to close your mortgage loan and buy your new home. That's a wrap on your quick guide on how to get a mortgage. If you're interested in learning more about the entire home buying process, please check out my quick guide series on how to buy a home. Based on your request, I will continue to produce valuable videos that dive deeper into the home buying process and home ownership in your hometown, even after you close. If this video was helpful to you, please hit the like button and subscribe to my channel. Thank you, and I'll see you in the next video.